What's up, guys? Welcome to the channel. So I've been investing in the stock market since I was a sophomore in college back in 2015. And during that time, I've made some money and I've lost some money. But during my investing journey, I have came up with some great habits and strategies that have really changed my life. In this video, we're going to talk about these top strategies on how I have been able to transfer my portfolio into some huge gains and what you can start doing to start making that happen for you. Hey, what's up, guys? My name is Chase and this is a Pain Pinter's Guide, and we are going to dive right into this video. Consider subscribing and liking if you made it this far. All right, so the first strategy that I'm going to talk about is going to be focused on when you get into the market. Not so much timing the market, but how much time you spend in the market is going to exponentially affect how much money you will be making. So basically, I'm urging you to start investing now. Research has shown time and time again that the earlier you get into the market, the more exponential gains you will have down the road. And it actually will mean that you are going to make more than somebody that is investing a larger sum of money than you at a later period of time, compared to if you were to start investing a little bit at the beginning, multiple years before that person. You will actually make more money compounding than the person putting a larger sum all at the multiple years down the road. The time you spend in the stock market gives you the benefit of compound interest. By starting early, I know that the longer I stay in the market, the greater the earning potential. You don't have to invest a lot, you just pick an amount and start now. If you take a look at this graph right here, it's stating that this original person started investing in their 20s. If you start at age 25 and you're investing the same amount over this long 40-year period, you will actually be making more money even though there is a greater sum being deposited at age 35 and age 40. Specifically looking at age 40, you are going to be starting at age 40 and putting in double the amount of savings that they were putting in at age 25. And by age 65 at retirement, you are still less than half of what the person at 25 was investing, and that's still less than the total amount that was invested in total for the age 40-year-old. So in the end, it's all about time in the market and allowing that sweet compounding interest to start making you some money. So get in there right now, whether it's a few dollars or a couple hundred, that doesn't matter. What does matter is that you are starting your journey at this period of time. Strategy number 2 is going to be focused on index funds over individual stocks. And we'll talk about that a little bit more down the road. But specifically when we're talking about index funds, it is taking the advantage of a group of a basket full of eggs, basically. And some of them are going to be good and some of them are going to be bad. But the majority of the time, you're going to continue to make money. Now, comparatively this to individual stocks, sure, there are those Amazons and those Facebooks and the Googles out there, but there are also a whole bunch of other stocks that are not going to end up making you that much money. And I don't know about you, but me personally, I do not have enough time to actually go and research and learn all about these individual stocks. And so I usually will just go with my either my VTI or my total stock market index fund that I have known has been yielding these great returns over the long period of time. And so this specifically has been seen and quoted by Warren Buffett. Warren Buffett is all about buying index funds. These index funds are highly diversified, low-risk investments that aim to replicate the average returns of a broad market index. And over a long period of time, they generally do outperform the vast majority of hedge funds. And so by buying index funds, you will beat the average hedge fund manager in terms of percentage gains. Now, you don't necessarily become a billionaire like Warren Buffett, but you will be able to say that you get better returns than many of the wealthy investors out there with hedge funds. Now, specifically, Warren Buffett bet against hedge fund managers that his specific index funds will do better than their hedge funds. Now, this might sound pretty bizarre to you, but the biggest thing is that it comes down to fees. Most hedge funds charge 2 fees, a fee with assets under management and then one for performance. And often this fee is basically about 2% on all assets and 20% on returns in excess of the benchmark, which this is a huge amount when it really comes down to it, depending on how much money you are having managed by these big hedge fund managers. And so this is proven based off of Warren Buffett's famous 2005 hedge fund bet. He wagered $50,000 that the S&P 500 would outperform 5 funds of hedge funds over a 10-year period. Basically, he was getting a fund of funds, and this allowed him to actually beat out these hedge fund managers 5 years in a row. And in the end, the S&P 500 won out over every single fund. So this example really exemplifies the power of index funds and how you don't really need to go to all these hedge fund managers or any of these other wealth management systems, and you can start investing into a broad market index and start making money through that compound interest and compounding the amount of time you are in the market. So this is not any financial advice, but me personally, since 2015, I had started my Roth IRA and I was investing into the total stock market index fund this whole period of time, and nothing has changed, and it has drastically increased. Specifically, over the past 5, 6, 7 years, I've almost doubled the amount that I have placed into these funds, just based on allowing it to compound interest over time. All right, strategy number 3 is going to be investing into the U.S. economy. And what do I mean by that? Well, basically, we are expecting that the U.S. economy is continue to grow and grow and grow. And that's actually what we've seen over the long term. And so I would recommend, like I said earlier, investing into the total stock market index, because that is a bet that the U.S. is going to continue to grow and be plentiful. The average annual return of a total stock market index of the U.S. stocks since 1957 all the way to 2018 has been approximately 7.96% annual return. And since its inception back in the early 1920s, the total stock market average has been about 10%. This long-term historical average is a more reasonable expectation for stock market returns compared to the 14.5% annualized 10-year performance on the S&P 500 over the past decade. So taking a look at this graphic right here, over the past 5, 10, 20, and 30 years in the total stock market average returns, over the past 5 years from 2017 to 2021, you can see that the average rate of return was 18.55%. I wouldn't necessarily say that this is an accurate representation, but it is something that you can see that you do not need any particular investing or research into individual stocks, but in total, you can make a large amount. What I always start looking at is over the 20 and 30 years, we're seeing a 9.51% and a 10.66% average rate of return. One thing that many people don't talk about is that you have to adjust for inflation, because as years go on, your dollar will actually buy a little bit less and less because the prices of things continue to grow and grow and grow. So if we're really looking at it, the average rate of return adjusted for inflation is going to be approximately 7%. Most people are trying to be conservative and will say that if you invest into this total stock market, adjusting for inflation, we're looking at a 6% average annual return. All right, strategy number 4 is going to be focusing on your tax strategy. A lot of people like to get into investing on a daily basis because I hear about the day traders making so much money. And if you are going to go down that route, you're going to be getting a lot of taxes associated with your returns. That's if you're making any money. The average day trader actually does not make money because they're trying to time the market and they're following a couple of indicators that might not necessarily show you exactly what's going to be happening. My non-financial advice opinion is going to be I would focus on investing into a long-term strategy. And what I mean by that is when you start putting money in, you should not be thinking about pulling it out on the next couple days or months or even the next year. By investing into a long-term period, you are going to be investing into a long-term capital gain strategy. And that actually will adjust the amount of taxes that are going to be applied to your profits and drastically lower them compared to short-term capital gains. So what is short-term capital gains? Well, that is any asset that you are selling and that you have owned for less than 1 year. And long-term capital gains is going to be any asset that you are selling that you have owned for longer than 1 year. And basically, you'll be paying 10%, 15%, or 20% depending on your filing status, as well as your profit you are taking on that sale of that asset. So as short-term capital gains and short-term selling does have its role, for the majority of the people out there that are not putting in that additional research and looking at it down to the nitty-gritty, the long-term capital gain strategy is going to be the one that works best for you. Number 5 on my strategies is going to be investing into value stocks or value indexes. And so now we're taking a step away from these giant index funds. After you've already done your initial allotment to these, you can start investing into these companies that you really love and you know they're going to work. And there's multiple different ways that you can do this. But at first, I would actually recommend you buying the book, A Random Walk Down Wall Street or The Intelligent Investor. And both of those are great books to give you a quick synopsis and understanding of this total stock of the stock market and investing as a whole. But by investing and researching yourself and finding these value properties, these value investments in stocks, then you are really going to be understanding and getting potentially those diamonds in the rough of stocks. And the best way that I would approach that is maybe considering going from a top-down approach, looking at an industry that you love, that you are doing something or using something or playing something or indulging in something on a daily basis, and then looking at that specific stock, that specific item, and seeing if you can start investing into that. Because if you are loving that and the rest of the world loves that, then that has value, and that also means that their company and their stock will have value. And so that is the top-down strategy. The other way is to go from the down to top strategy and the bottom to top, basically. And that is going to be focusing on the specific item that you like and then investing into the industry that is in. I think both of those are great strategies, especially if you've already done your specific allotment into these index funds on a regular basis. Then you can start investing a little bit of proportion of that, maybe 5 to 10% of the capital that you're going to be investing on a monthly basis into these individual stocks for a potential greater return compared to the index funds. That being said, they could also go down just as likely. And so that's why it's that much more important that you are investing into specific stocks that have a lot of value that you use on a daily basis. Now, these are the top 5 investing strategies that have really made a big difference in my investing portfolio, and I have seen some great returns based on these particular things. I think the biggest thing that has made the greatest impact on my portfolio is that I have been investing since 2015, and since then we have seen a great bull run associated with stocks and cryptos and everything like that. I'm using M1 Finance. I'm investing on a monthly basis. I have made a specific pie that is pulling from multiple different index funds and a few individual stocks that I really truly believe in. But again, that's really a very low percentage of mine. And if you're interested in something like that, then there will be a couple videos up here that are going over the different investing apps and ways that you can start investing and starting now to start building your portfolio. I hope you found this helpful. Thank you so much for watching this. It really does make a big difference to us. Consider clicking that like button if you've stayed this long. I hope you have a great day. And as always, we want to remind you that we are here from your first penny to your first million. We'll see you next time.